Yo, what is good? We're back with another video. Today we're going to be going over how to find high probability inverse fair value gaps. If you're not familiar with them, I'm going to explain them in this video. If you're not in the free Discord, go join it. It is linked down below. But other than that, let's get right into the video. So what is an inverse fair value gap? An inverse fair value gap is a fair value gap that gets ran through and then will be supported as price to go in the opposing direction. So right here we see we have a bearish fair value gap. If we run through that, it is then called an inverse. So I'm going to show you how exactly to find higher probability inverse fair value gaps. So right here on the hourly chart, we see that we are delivering from this hourly fair value gap, and we just swept this old low. So now we have an old low swept and an fair value gap. So heading down to the 5-minute chart, we see here, right, this is the hourly fair value gap, going to get rid of that. Here's the sell side level. And then right here, we see this fair value gap, right? This is a high probability inverse fair value gap when it gets ran through. Why is that? It is because it has supported price 1, 2, 3 right here, and then we finally get that push through. So not only did it support price to push lower, like right here, we get that push lower from here, we get that push lower here, and then we even get a push lower right here, and then here we finally push through that fair value gap. And then right here you see we tap it, and then we finally expand to take out the internal draw up here. So this right here is a high probability inverse fair value gap to me. I do not use fair value gaps like right here, or actually let's say right here. I will not use something like that unless, which I will show you later in the video, so stay tuned for it. But this right here is a higher probability fair value gap that turns inverse because it has supported price to go lower. So let's go into the next example. Right here on the 15-minute chart, you guys probably see where is the fair value gap I am talking about. Right here. We see it has supported price 1, 2, 3 times to push a little higher. And this is where a high probability inverse fair value gap also comes into play. Whenever it has supported price and has delivered from a PD array that is bearish if we want it to turn to a bearish inverse fair value gap. So it has supported price 1, 2, 3 times. These are 15-minute candles. 1, 2, 3. So for 45 minutes, this has held price up. And then we come up to this bearish fair value gap, get that expansion lower to close beneath it, extend this out. Right here we see it supports price to then push to this draw on liquidity, this fair value gap, and it takes this low out right here. So this would have been, if you just risked off that candle, a 1 to about 1.7, so for 56 points right there. But this is where risk to reward comes in. When do you stop out of the position? You stop out of the position if a candle closure happens above it. So that now that it has turned to a bearish inverse fair value gap, if we get a closure to the upside on this fair value gap right here, you stop out of your position. Or if you see that it is just expanding higher, or if you want that hard stop in there above this order block. Why is this an order block? Because a bearish fair value gap has supported this expansion lower. This now should resist price. So you can stop out of the position up here if the body of the candle gets ran through, or if we get a closure above. Usually the closure above is when I will stop out of a position. Let's move on to the next example. Okay, so right here we're on the 5-minute chart. We see that we have this fair value gap right here. We have taken out buy side liquidity, and if we put this box on, you see all these bodies respect it. Even this one, it respects it to the tick right there. And as soon as we close beneath it, now we have an inverse fair value gap that is higher probability. Why? Because look at all of this support. All of these candles have been supported by this fair value gap right here. And if you watched my CE video, you see all these bodies respect CE of this wick with the fair value gap. So if you have not watched my CE fair value gap model, go watch my very last video that I just uploaded yesterday. So go watch that if you're confused about what this model is right here. But this CE fair value gap right here supported price this entire time. And right here, whenever we get that closure below, let's extend this box. We test it once, we come the entire way back up, we actually make equal lows, and now look at all these bodies. All these bodies respect this as an inverse fair value gap, and then we continue down to that overall draw on liquidity, which was lower. So this is a high probability inverse fair value gap. And now we have a CE fair value gap right here that is inverse. We have this long wick, we have this fair value gap that has supported price, then we get that expansion lower, measure out this wick. If you don't want to take it as soon as it gets in, wait until the CE fair value gap that is now inverse. High probability inverse fair value gap because it has supported price in the opposing direction until we get that expansion lower. Let's move on to the next example. So this example is a little bit different. Why is this a little bit different? Because this fair value gap did not support price in the opposing direction. This is another way to use a little high probability inverse fair value gaps. I don't use them like this as much. I like to see it support price, but this is also another way you can use them. So right here we have market open at this candle right here. You see that we get this expansion higher. The overall draw on liquidity this day was higher. And then you see that right here we get this support from this fair value gap, also as well this order block right here. So we have support from a bullish fair value gap and a bullish order block. Expansion higher, and we close above this fair value gap right here. We trade back into it, bodies respect it, wicks do the damage, and we actually have a BPR. What is a BPR? Whenever we have a bearish fair value gap and then we expand through it with a bullish fair value gap, or vice versa, if we have a bullish fair value gap and expand through it with a bearish fair value gap, it is now a BPR. So right here you see that we have this bearish fair value gap and a bullish fair value gap, trade into this, and then we expand higher, taking out these overall draw on liquidities, this low resistance liquidity run right there, and then you see that we just chop out the rest of the day. So this is another way to identify high probability, not as high probability as I like them to be, but I thought I would throw this in here so you guys could know. If you like this, go back test it. Not saying it works all the time, never do. Just go back test for yourself, see what you like to do. On this example, you want to see delivery from a bullish PD array running through a bearish fair value gap. Use the bearish fair value gap to take your entry, and then use your stop loss on a closure below the bearish fair value gap. Let's move on to another example that I actually took a trade on. So right here on Thursday, January 11th, I took a trade on this inverse fair value gap. My first entry was on the 15-minute chart on a bearish fair value gap, but we are on the 5-minute chart because that is where the example is. So right here on this on this bullish fair value gap right here, where are we delivering from? We are delivering from a 15-minute fair value gap actually. So this right here is a 15-minute fair value gap right here. So this 15-minute fair value gap, actually it's right here, 15-minute fair value gap, we have this bullish 5-minute fair value gap. What has this done? It has supported price right here to get this move up, and it has supported price right here, and then we finally get that closure below. I take my entry on the closure below because I'm already in a position. So my position gets moved lower. I'm still in the overall green. My position moves down to right around here, and I actually took it on the NQ, but it's the exact same example. This is the ES. I didn't even realize that, my bad, but it's the exact same thing. But right here, when we get that closure below, take my entry on this candle right here because I wanted to see the closure below. And as you see, we trade into it once, trade into it twice, and then we hit that overall draw on liquidity down here at these lows on previous day low. So that is how you find high probability inverse fair value gaps. Whenever a bullish fair value gap has supported price to go bullish and then gets closed as a bearish inverse fair value gap, or whenever a bearish fair value gap has supported price to go lower, we expand through it and then turn it inverse to then go higher, and it will support price to go higher. Your stop loss will be a closure below the inverse or above the bearish inverse. I think I said that right. Your stop loss is a closure above or below the inverse. That is all you need to know. And yeah, that is the video. So I hope you guys understand what higher probability inverse fair value gaps are now. If you're not in the free Discord, go join it. It is linked down below. I am going to have another video coming out later tonight on a weekly outlook, what I think this upcoming week will be. I'm going to start doing those and daily market recaps. So yeah, going to get that. If you have not voted on my series that I am thinking about dropping, go vote on it. I need 30 votes for me to upload it. So other than that, I'm out of here. I hope you guys enjoyed the video. If you did, drop a follow in the Discord. I don't need your likes unless you want to be so kind to drop a like. Other than that, I'm out of here, guys. Peace.